the end of the day, I don't think the merchant or the cardholder care.
They don't care about one thing.
All they care about is that it's an easy user experience, that they're not spending hours at the end of every month reconciling, that they're not losing money because of outages, that it's easy to consume. And I think it's just come down to what's the customer experience.
Hey, Tedd Huff here. Ever thought about how you could streamline your application and underwriting process? Well, let me introduce you to Under. Why keep using the outdated methods of PDFs when you can digitize them effortlessly? All you gotta do is upload the PDF, send it out for digital signature, and voila, you're set for the digital age. Are you curious on how to make that happen? Head over to under.io/FTC and get started for free. It's really that simple. Welcome to FinTech Confidential, bringing you the people, tech, and companies that change how you pay and get paid. Welcome to another episode of FinTech Confidential's Uncut. This is where we go deep into it, exposing all of our opinions and all of the things that we think about without cutting a single word out. Today, we're going to be talking about payment facilitation, what it means, who should do it, who shouldn't do it, why does it even exist in a lot of cases. And I'm being joined by two fabulous ladies. We have Ashley Isenberg and Elaina Smith joining us. Ashley is... See, and this is the part that sucks about Uncut, is from Fractional FinTech. I wanted to throw like a title in there, and I just stuck. Ashley told me earlier as we were getting started, hey, don't throw the CEO, founder, all that stuff in there. So I got stuck. But we also have Elaina Smith on, and she is the CFO at SecureCard. And so we are going to be talking about all the different things around payment facilitation. For me, it means a lot of different things, and I've been very vocal about it over the years. But Ashley, I'd like to start with you, just kind of give a little bit of background. Don't go too deep, but also give your perspective on what payment facilitation is in the first place.
Yeah, so we'll call me an advisor in this space. We'll use that title for now. So I've been supporting a few folks as kind of their fractional chief revenue officer, fractional chief payments officer, and kind of helping them navigate through payments. But just a little background. I have spent probably the last 7 years of my career specifically in payment facilitation. Prior to that was a wholesale ISO myself. So a little bit of experience. I think when you think about what a PayFac is, it's really what is the user experience, right? For the merchant and the cardholder, and in most cases, the merchant. And so when I think about PayFac, I think about embedded, right? I think about seamless onboarding, seamless user experience within a software product. So that's where I think about it. And I know part of this conversation got started on onboarding, right?
It did.
Not the big thing of PayFac, right? Yes, it offers an embedded experience. It removes we'll call it ping pong of the customer, user experience. But PayFac is much bigger, right? PayFac is the ability for a company to take on all of the risk and ownership of an agreement, which while that sounds great because maybe you can monetize more, it is also very scary, and a lot to take on. So.
And actually, you bring up a really, really good point is this all started, Elaina made an amazing post on LinkedIn, which just drew me in to feel like I had to answer it. I couldn't go without answering it. And really just turned into a conversation between us and a handful of other experts in the industry. So, Elaina, I would love to get your perspective on what a PayFac is and why you actually made that post.
I'll start with why I made the post, I think makes the most sense. So what I'm seeing we have a wholesale ISO, and we do it a little differently. I'll get into that a little later. But what I'm seeing is this flocking to the PayFac model and acting like it's this panacea and the cure-all for everything, when it's not necessarily the best model. I think that what happened was the ISO model was very broken. And instead of trying to fix that, we are heading in this other direction. All of a sudden, it became the cure-all for everything. So when I think about PayFac, I think about someone who wants to take ownership of the payment relationship. I think about someone who wants to control the payment experience for the merchant and its customers. So or the software vendor and its customers. A lot of the things that Ashley said, controlling that overall customer experience are so important. But I do think a lot of that is possible with an ISO model. If you go about the ISO model differently, I think the thing with the ISO model is that so many of them are just stacked on top of legacy processors and using all the legacy processor services, and they haven't done anything to innovate. And so they're stuck within that box. And so my experience we have a wholesale ISO secure bank card. We've tried to break the ISO model and build it from the ground up, built our own platform to be able to do our own billing, merchant funding, those kind of things. So we can control more of that merchant and customer experience.
Oh, and you both hit on the two things that for me really are the key pieces. One is the onboarding and how seamless and easy to use that you can make it. How good can you make that user experience, that customer experience really draw in? And then on the other side of it, how can you best manage the funds? And Elaina, you'd mentioned that legacy providers have a lot of restrictions on how to manage the funds. And so PayFacs seem to be, and still today, I still lean a little bit towards PayFacs still being a good way to go to control a lot of that. But my main concern is the idea of having so many retail style payment facilitators. And let me kind of break down from my perspective. I've got three little pieces as I've built out a handful of these PayFac programs. Is that you've got the retail side, which everything is done for them. All they do is focus in on making sure that it's embedded properly. So think like Stripe or Square. I shouldn't say Square, but Stripe is a good one, right? So Stripe allows you to embed it relatively quickly and gives you that whole experience up front. That's really that retail side of the model where you don't take any of the risk. You don't do any of the UI. You just get the benefit from the fact that it was a fast onboarding and you get the movement. And then I move into the wholesale side of the house, which is where you take on everything, right? So the bookend is the other. You take on everything. So you're basically acting like an ISO, but the main difference really comes into the funding side of the house is slightly different than what you would use with a traditional processor or platform. And then, of course, we always have these fun things that are in the middle because obviously we got to have the banks approve all of this fun stuff. And you guys know how much fun.
You're back.
So I apologize. Look, so this is going to be fun. Technology not working with me. So, we'll go ahead and pick up where I left off. And I guess where I was going at is the financial institutions have the final say really on, at least in the US, on who can and cannot be a payment facilitator. And so the rules change based upon the risk profiles. And that brings me to the other pieces that risk profiles mean a bunch of different things. And I guess I would like for you guys to just kind of play off or what do you think about how I position that?
About the banks having control and there being different types of risk profiles?
Well, I think it's more of starting with the different types. Do you agree with the three different types that I talked about? If not, how not? If so,
you cut
why?
out with the three different types. So can you start there with where you went over the three different types?
Yeah. So I don't know where I dropped off.
You were launching right into that. You were about to tell us you had three different types that you were going to share.
All right.
So
well, hey, I don't know how much of that. Okay. Well, so I guess where I was going is the three different types is the retail side, which is very Stripe-esque. It could be something like a Tilde or a Payrix that really falls into the retail side of the house, which means that they bring the tech, they bring the risk, they bring the underwriting, they bring everything. And you as the software service provider, you get the benefit of all of that without any of the risk. Then I go to the complete other side of the house, which is the wholesale, which is number 2. I go bookends first. Number 2 is the one where they do everything. They do the underwriting, they do the onboarding, they have the authorization, they have the capture, they have the settlement, they have the funding, they have all of the things that if you didn't know any better would be a wholesale ISO. And then you have the ones in the middle where the bank says, hey, I feel kind of comfortable with you doing these things, but I want you to have this company do these things. And typically that's around risk monitoring or AML, KYC. If you're not well versed in the risk and underwriting piece of it, they may ask you to outsource that to a company. A lot of times it ends up being an ISO. I've launched a couple of those programs to really take that on. And I think Infinitec just launched another program recently that dives directly into the retail side of it as well. So those are the 3 pieces that I see happening in the marketplace. Did I leave anything out? Did I miss? Is there something you don't agree with? I'm really curious.
Yeah. I'll say this. I think I look at the industry through a different lens. And so I kind of look at, we have legacy processors, right? So I'm going to take PayFac out of this scenario for a moment. We have kind of our legacy processors, right? The Staples, the WorldPays, the Fiservs, originally First Datas, Vantovs, right? That have been in the space for many years. And then we have kind of the processor 2.0, right? And the processor 2.0 is the Stripes and the Adyen's, right? They were purpose built. They started as payment facilitators, maybe the Squares. It really gave tech and more financial services to folks. And that model, right, made sense. It opened some people's eyes to a different way to handle payments and really embed that experience. And then I think we have that kind of 2.0 of the Stripe and the Adyen, right? The Payrix and the Finexes of the world that came out and helped with everything you just talked about on the wholesale model, right? How can we, from an infrastructure perspective, support you as a payment facilitator? But then how can we also give you kind of that managed PayFac experience where you can take on some of the risk, take on some of the portability, ownership. You can get almost there, right? But we can give you, right, everything you need from a modular perspective to support that. Now I think we're seeing 3.0, right? 3.0 is the Payablies and Pay Engines and Rainforest and folks coming out with what I'm seeing more verticalized PayFac as a service solutions, right? And when you think about the complexity we're seeing in kind of the 2.0 and, the 1.0 version of embedded payments, you can't build everything for every use case. And when you're supporting a vertical use case, you either have to allow people to build that functionality, which if they're working with a legacy processor, and a lot of the times, even if they build it, it doesn't mean that they can do it, right? You can build split funding, doesn't mean the legacy processor is going to allow you to split funds. And so I think we're seeing folks go deep into these verticals and build the feature sets on payments and, more importantly, financial services that a lot of the software companies that are bringing payments in-house are going to need, right? And those software companies, the ISVs, the SaaS companies are primed, right? They are primed in market right now to bring a diverse set of financial services to merchants, but they also have to have those 2.0s and those 3.0s. They're developing the tech in the verticals that they serve that benefit their customers and their cardholders, right? And I think I'll see even vertical enough to say there's B2B2B and B2B2C, but then there's card present, card not present. Then there's actually specific must pay industries, right? The must pay industries like insurance and healthcare need much different services than a typical e-com provider.
Yeah, and I think it's interesting as you break it down into the verticals. I've always looked at it from functionality. And that's my product brain kicking in, right? So those are personas of a particular need. And, really the verticalization really, from my perspective, has more to do with the labels and the process flow versus the actual functionality. But Elaina, I'd love to get your perspective. I know that we kind of push back and forth a little bit on it. I know that you guys over at Secure Bank Card have done some really cool stuff on the back end, but how are you seeing it from your perspective on why people are using payment facilitators? Or using the payment facilitation model is a better way to word it.
I think that they're wanting to have more control over the experience, but what they don't understand is that more control comes with more responsibility. But I like what Ashley said about these different levels of, these hybrid models where you can hand over some of that responsibility. If you can't manage the risk and the underwriting on your own, then you can have this kind of hybrid model, and that I can see working a little bit better. But you see so many players want to get into and monetize payments, and then they get in and it's too late and they've, lost the farm because there's so much that they don't know, and they don't know what they don't know. So they have to have a basic understanding, or at least hire those roles in so that somebody can manage those pieces for them. And I think also, to Ashley's point, we're seeing this 3.0 version. I think in that 3.0 version, my perception, at least, because we don't do a lot in the PayFac space, but I think in that 3.0 version, there's a complete ownership of end-to-end payments. Whereas before we were maybe, outsourcing the gateway, but, managing the funding and the billing and that kind of thing. So in the 3.0 version, it seems like people are building the gateway. They might be piggybacking on a processor, but they're, doing all the other things in-house. So they're taking more control of the overall process so that they can deliver a better experience and a seamless transaction from end to end to their customers as a result.
I mean, you're even seeing, right, the 1.0s and the 2.0s all went direct, right? I mean, if you look at Payrix, Infinix, Stripe, Adyen, they're all processors. Adyen, I think at this point is a bank, right? And so they've all gone to that
Stripe
point,
too,
right? Yeah, correct, right? So they've all come in and said, we're going to take ownership over this, right? We've built the tech. Why are we going to rely on somebody else when we can just go straight to the networks, right? And you're seeing things like VPC, right? I think it's been called VPP in the past, now VPC, but you're even seeing the networks, Visa and specific, be more open.
So are you talking about Visa Payment Connect?
Yes.
Okay. All right. Well, I still remember way back in the day when it first launched, where it was Visa Connect, Fast Connect, I think is what it was, like Visa Fast Connect. It was pretty crazy, but sorry, I didn't mean, I just want to make sure that we were talking about, we already have enough acronyms and enough alphabets. So
I was just going to say,
let's at least break some of this stuff up. So continue. I agree that people are looking to figure out how can they be more direct and how many pieces of the supply chain can they cut out. Do you think it is more in the areas of, I want to control my own destiny, or is it more of, I don't know any other way to do it? And I'll start with you, Ashley, on that one.
Well, I think, Elaina kind of alluded to at the beginning of the conversation, right? There wasn't another way to do it because the ISO model was broken, right? There hadn't been a lot of development in the ISO model. And so I think PayFac became synonymous with tech, right? And the two terms kind of got put together. So folks struggled because they didn't know another model, right? And I think if we were to go through the PayFac list today, we'd probably see a good 10 to 20%. This is just my guess, right? Not data driven, that are now removing away from the PayFac model and going under a managed solution, right? So I think tech started to come to the forefront. Folks wanted a way to do what Toast and Uber and others had done. And so PayFac was the only way to do it. Folks got in way over their skis, right? They didn't have the people, as Elaina mentioned, that were there to actually understand payments. And so you saw these kind of managed solutions come out as a resolution to that. And so I would 100% say there wasn't another way to do it. And I think we're seeing a lot, right? We're seeing the new wave of processors come to the market. We see those 3.0s who I think are going to leverage those processors in some cases. And so I think there's easier ways to do it. And I manage PayFac or wholesale ISO or retail ISO, right? They're all the same thing. They're just different user experiences, right? Both on how you accept the payment and how you settle the payment.
I think
how do you feel about that comment? Because I think this is one of the things that sparked the whole post was this specific case.
Tell me what an ISO is. Everybody calls themselves an ISO. It means so many different things to so many different people. So you're right. I mean, you can use some of these terms interchangeably because they're acting in the same way. I think the big difference for us is we just never operate as that master merchant with the TIDs under it, like a PayFac would operate. Everyone has a unique MID, and there's pros and cons to that in doing it that way. But to your earlier point, I would just say that I think that these companies in going this direction they wanted to have more control over the experience. Because when I think about our scenario, I'm only as strong as my weakest link. I can do all the things right. I can have everything in place that I need to. But if the processor drops a transaction on the floor and doesn't clear it, that ends up reflecting poorly on me. Or if the gateway goes down, that ends up reflecting poorly on me. So I think that's why we're seeing this movement towards people wanting to build the entire chain of services so that they can take ownership. I would love to build a gateway. Do I, want to put the funds toward building a gateway? No, that's a huge spend, but I would love to build and own a gateway because then I can control that and I can build it the way that I want to build it. I can integrate it fully with my product. It's seamless to the end user. It all ties together. But at the end of the day, I don't want to raise any outside funds. I want to use our own funds. And that's just not a viable option right now. So instead, we do the best we can with what we've got. I think we're just trying to eliminate as many of those weak links as we possibly can.
Yeah. Well, Elaina, based upon what you just said, it takes me back, and I can't remember, maybe it's been a couple weeks ago. The CEO of Rainforest made a post and really talked about, hey, our stuff went down, but we let everybody know that it went down. Not only to let them know that it went down, we had all hands on deck, and it was solved within, I think it was minutes, maybe an hour, versus hunting down to find out who was the real cause, where did it really come from. And they were able to communicate to the client that they were fixing, they were on the solution, which gave a little bit of air coverage for them for that particular issue. And I think that is a big piece that we're starting to see in these folks that decide to go the full value chain. But what that brings me into the next is why a PayFac, right? So we talked about what it is. We've talked about all the different ways it's laid out. We talked about a bunch of the different parts in a couple of different areas. But why would you want to go? Why should someone go PayFac versus just doing a traditional merchant services that they could have branding and full control over? And actually, I'll start with you again on this one. Sorry, Elaina, I want to get her perspective because
she's the one to answer that question. She's going to know the PayFac side.
Yeah. I think it's interesting though, just going back to what we were just saying about user experience, right? I think that's the biggest shift that's happening right now with, call it a managed PayFac or a full payment facilitator, is folks aren't recognizing you may hire a whole team of people, right, who understand how to build a solution for healthcare, right? And they know exactly what the customer is looking for, whether that be the cardholder, the patient, or the actual medical facility that's serving those patients. They know what those customers are looking for. What they don't know what their experience is with their current payment processor, right? And it may be very disjointed, but when you take that on, you have to also understand how to be upfront and answer those questions, right? Outages happen. The biggest guys have them. The smallest guys have them while you're in development, right? Being open and honest about it. But helping your customers understand how to actually service that is where I see the biggest breakdown. Everybody gets into this space, but then they're not actually helping, right? Those companies who are embedding payments serve their customers. And it's the biggest thing that I'm doing right now is helping folks who are saying, we made the decision. We picked a partner. We're fairly early stage. Who do we actually hire on right now to help us understand how to serve our customers, right? How to actually communicate outages, or if something with billing was incorrect, or a transaction failed, or a refund got lost. How do we answer those questions? That's two different products, right? It's two completely different products than what they may have initially built for with a SaaS product. So I think just helping with that terminology and how to support that has been an interesting transition, right? A lot of resources for how to get payments in, not a lot of resources out there for how to scale it and grow it. But back to your original question. Sorry, I went off on a little tangent there.
It's okay. It's okay.
All right. When you say PayFac, right, I just want to make sure we're speaking the same language. Back to my prior point. do you mean full stack, full risk? Well, we'll use the ISO model. I am the registered payment facilitator. Or do you mean a managed PayFac experience?
So that's a good point. The way I look at it is that if I am not doing a 1-to-1 ratio for merchant ID to the card brands, like one merchant gets one ID, the card brand gets that one ID. If you're not doing that, it's PayFac. The other side of the house is that it is traditional processing to be one mid, one person registered with the card brand. That's what I mean by PayFac. Could be registered. It could be like the managed. It could be the wholesale unmanaged. It could be somewhere in the middle. But really, it's really like looking at, because there are people and there are companies and there are softwares that have absolutely no business. And there have been many that I've told, just go the traditional route, find a good partner that has a great onboarding process, that has the support, because give an example, they do 10 accounts a year that are extremely large volume, but they're broken up into different locations is the best way to describe it. Well, they're doing underwriting one time and then they're just adding additional locations. It really doesn't make sense for them to go the PayFac route, but their main concern had nothing to do with really being a PayFac, but they were told by a provider, a legacy provider that offers a managed service PayFac, that was their best route to go. And so now trying to undo all of the craziness that provider has bestowed upon them. Now making sure that they don't hire the people in the risk and the support and all these other different things. And like there's so much stuff. And that's kind of when I look at who doesn't make sense to be a payment facilitator.
Yeah. So I'll say this. I'll start registered payment facilitator. Very often, I don't think it makes sense, right? Where I see, hey, I'm going to go be a registered payment facilitator is maybe the 3.0s that are building a much more robust solution, right? Everything from the gateway, and they're selling into an entire industry or two or three. Someone who's processing well over $1 billion to $2 billion, right? But also has strong M&A plans, right? So they might be acquiring folks that are whole risk ISOs. They might be acquiring payment facilitators, right? Taking those clients in, merging that business is going to be much easier when they're a registered payment facilitator. Occasionally you see some folks that, depending on their investors, right, their financial model requires them to take that ownership. And for some reason, simple portability in the contract's not getting it done. So most cases, I don't think it makes sense to become a registered payment facilitator. When it comes to embedding payments, right, a managed PayFac solution, it depends. Every company's so different, right? And so I don't want to go into the like startup, later stage, right? Make sense at any point, as long as you have a product, right, that naturally receives or pays out, right? So if you think about how you move money, if there's any complexity to how that money moves, maybe there's a trust account involved, or there's 2 or 3 vendors involved. You see it a lot in legal or insurance. I think it's absolutely when it makes sense to become a payment facilitator, right? When you're having to control the way or split the way that those funds settle. I think anytime that you're vertically focused, it makes sense to bring payments in-house. Where I don't see it making sense is folks that are super horizontal. They do B2B to C, they do B2B to B, they serve just small merchants in general. In most cases, I don't see it making sense, right? Because you're not building a repeatable underwriting and risk model. And that's the biggest thing that you're taking in-house, right? Is how do we pick up the consistencies and even friendly fraud and prevent friendly fraud, but also on the back end. So when you start to get very horizontal, I don't think the payment facilitator model makes sense because you don't understand the risk you're taking on. So if you're not evaluating every merchant and setting up rules for those merchants on their own, oftentimes you're probably walking into some pretty mucky waters, and you may not have the team or the resources for that. So why not leverage somebody else?
Support provided by Skyflow. What if you could build fast but not break privacy? What if you could ensure data privacy, governance, and compliance with just a few API calls? What if you could worry less about PCI requirements while actually improving privacy and security? How much more time would your team have to truly innovate? How much faster could you build and ship new features? How much more powerful could your app be? Skyflow is a zero-trust data privacy vault delivered as an API. Skyflow's radically simple design lets you collect, secure, and tokenize personal information like card data and payment details. And with built-in features like encrypted data analysis and sharing, anonymization, and advanced governance, your days of choosing between data security and data usability are over. Whether you're just concerned with PCI compliance or need to go further to include CCPA, GDPR, SOC 2, and beyond, Skyflow has you covered. What if you could build fast but not break privacy? With Skyflow, you can. Visit skyflowsecure.com today to learn how. So the other place that I see, and I gave an example of one, it's a high dollar, very not complex, but unique use case, right? The other place where I start to see it is where the documentation, whether it be regulatory documentation, whether it be something that requires a more hands-on approach that may take a day or two to really dive into it. And the financial institution that is being the bin sponsor for that doesn't feel comfortable with doing a exposure-based underwriting process. So really it comes into that piece of it where if the bank isn't comfortable saying, go ahead and sign them up, finish the due diligence, and then complete the process, then that's another one that doesn't fit very well.
Yeah.
But one of the things that you hit on was the money in, money out, and controlling that. And I think that is more of a side effect of the lack of flexibility from the traditional processors. Mm-hmm. Because I know a lot of folks have taken on that back end piece of it, that clearing, that settlement, that money split, that money movement. And that has been a nice way to get the control they're looking for without having to go and choose a fully managed solution. Elaina, I know you spend a lot of time on reconciliation. I think that was our entire conversation the last time you and I sat down. Help us understand, like, from your perspective at Secure Bank Card, like, what are some of the ways of reconciling and managing that you're seeing within your organization as a traditional ISO model that sounds like it could be a good fit when we start to talk about the payment facilitator edge cases?
So Ashley alluded to this with merchant funding and being able to do creative things with merchant funding. And that is exactly why we built what we built, is to be able to have that flexibility. So just to give you a little background on the way that we operate, we only have the processors authorize and clear for us. We do everything after that point. So we receive all these transactions in. So the point of card acceptance to the point that we fund it out to the merchant, we do everything in between. So we built our own platform so that we can handle all the merchant billing. We handle all the merchant risk on that platform. We handle all the merchant funding. So if someone says, hey, we want to split, 90% over here, 10% over here, whatever kind of funding arrangement that they have, we can accommodate that because we're not relying on the processors funding and outsourcing that from them. We control that ourselves. And you also mentioned reconciliation. There's this whole, now that we're managing the funding, we're getting all the funds in from the card associations and having to balance and manage that. And we're in control of, if there's an outage and we don't get all of the funding and it doesn't all get cleared, then we're on the hook for that. So it's a lot more responsibility, but we're also very much in control. If we have any kind of issue, we're the one going back to the processor and saying, hey, you didn't give me all my transactions. You sent this much to Visa. You only sent this much to me. And they still don't understand how we know that as quickly as we do because the platform is doing all the reconciliation for that. But that's we talk about customer experience. That's how you stay ahead of issues. I know that there's an issue before the cardholder or the merchant is any the wiser. And I'm chasing down that issue to fix it before it ever gets to that point. So we talk about, breaking the ISO model and rebuilding it. That's what we've tried to do. I want to take ownership as much as I can over that process. But again, it comes with a lot of responsibility. So if we miss a new assessment that comes out, that's on us. We end up eating that. So it's the control you get, but the trade-off is the responsibility. And you might be on the bad side of that where you do something wrong and you mess up.
I think we're all hitting on something interesting here. At the end of the day, I don't think the merchant or the cardholder care if we're PayFacs, processors, ISOs. They don't care, right?
They don't care about one thing.
All they care about is that it's an easy user experience, that they're not spending hours at the end of every month reconciling, that they're not losing money because of outages, that it's easy to consume, and it's not the traditional legacy relationship it used to be, right? I think I got into payments in 2010, 2011, and the perception of what I did for work is that I sold credit card machines to C-stores and stole a bunch of money from them, essentially, right? I mean, you were everybody's least favorite person. And I think it's just come down to what's the customer experience. I mean, a lot of where I'm spending my time right now is with the customer, because I felt like I sat on the other side of this world for so long. We're all out here trying to solve problems for these customers, whether it be the merchant or the cardholder experience. None of us are sitting in the customer's seat, right? We don't actually know what they need. That they don't care, right? They don't care who we are, how we did it. They just want to know that it's an easy, consumable process and that reconciliation is going to be accurate. Funds are going to hit on time. They're not going to have outages, right? So I think no matter whether you're a processor, a wholesale ISO, or a PayFac, is the tech good? Does it serve the feature functionality that vertical needs? At the end of the day, I think that's really what matters. And that's why I think we'll start to see some hopefully some verticalization in this industry where certain verticals are going to go to certain providers to solve the needs of their customers.
So what that brings me to really think about is going so vertical specific, is that, can it support that? Because these are in a lot of cases, to maintain compliance, to continue with roadmaps, to keep up with the changes, and then the ever-changing needs and desires of your customer, in this case, whether it's a merchant or a technology provider, you really start to get into all of these different pieces. Like an example would be, there are a number of folks that will offer a prepaid debit card as part of the program, and then, or they'll do a credit card as part of the program. And then you've got digital wallets to be able to transfer funds internally between other folks that are on the same platform. And you've got all of these things that are going on out on the periphery. Not to mention when we start to get into cryptocurrencies and other digital assets that start to happen, and it just starts to fragment to a point. Most of the, I shouldn't say most, I almost said every, but there are a lot of very curious people trying to understand how to stay ahead of the curve. And a lot of them don't even go into the granularity of where their customers are spending their money, and they're just throwing things at it. So I don't know really where I was going with that, other than the fact I said,
can you build a product roadmap, right? Is it scalable, right? To build a product roadmap for one vertical, I think is what you're asking. Is there enough to monetize there for the business? Does it actually stand on its own 2 feet?
Are there enough, like, get an example, like, are there enough local law firms to use a law firm product? Or are you looking at a professional services product that covers a whole bunch of different verticals that have similar needs? Maybe not exactly to the label level, but across the board, their workflow's the same.
Yeah, I think it's best to
layout.
focus on a niche and really serve that niche. And then you figure out, how do I go rinse and repeat this niche to some other? Get that right. Because like Ashley said, it's all about the customer experience. And I love how she said, PayFac equals tech. And tech people, software development especially, understands the user experience better than payments people ever have or will. I hate to say that, but they're all about that. And that's why they're flocking in this direction, because it's all about the user experience, as it should be. And we've kind of neglected that on the ISO side, and we have to make up for it and figure it out, or else we're going to be dinosaurs.
Right. And we have all these models, right? Because payments is a compliance and regulatory industry, and we have to figure out how to help these companies move the money in a way that they're obviously not walking into money transmission or other regulatory issues. But I completely agree with, verticalization. I don't know how you build a product roadmap right for horizontal if you want to start to think beyond just payments. If everybody just wanted payments, right, this conversation's pretty short. I don't know how much time we'd fill up, right? But if you're actually thinking about what the merchants are looking for today, they're looking for faster funding, right? So now you're getting into disbursements products. Mm-hmm. They're looking in maybe a must-pay industry, right, to accept multiple different types of modalities, right? If we don't think about just the 10 or the 20% of users, especially in the US, there's a whole lot of users out there that are underbanked, unbankable, or in rural areas where they don't have access to certain things, and they need multiple ways to make payments, especially, right, in the must-pay industries. They need multiple ways to fund those, right? Whether it's to a card or to support issuing or lending in some cases for small businesses. And so if you can't offer those other feature functionalities, is payments on its own 2 feet big enough business right now if you're vertically focused? And I think the answer is no. But if you're looking at a vertical focus and you're expanding out into other financial services that may have higher or equal margins, that starts to become an affordable, scalable business that stands on its own 2 feet.
I think where I was headed with that is make sure that when you choose the vertical that you're going into, that it has enough of a critical mass to be able to support the ongoing business case. Because I've seen way too many times where there's a software provider that says, I want to be the provider for dry cleaners. I'll just throw one out, right? So dry cleaners. And they look at it and they're like, well, there's not enough margin in the dry cleaner. And on top of that, there's some additional risk around charging for things if it's a subscription based. And like they go on all these different things. And then you realize that even to do a managed PayFac, it doesn't make sense for them to do it because there's just not enough revenue in it to be able to support all the different pieces. And so then they fall back on the traditional ISO route. And then in a lot of cases, they're stuck with really, really bad experiences. And I guess it's kind of where I was going with that is it has to be a market of a certain size in order to be specialized and verticalized into it well enough to turn a profit.
And how are you going to sell into that market? Are you, as a software, going to be the one selling into that market? Are you going to rely on someone else to sell into that market? You see some interesting hybrid kind of things going on in the ISO market where they rely on the ISOs and agents to sell into these opportunities and say it's agnostic. And then once it gets to critical mass, they take it all back and they, charge an extra fee to take the processing and all that. So that's an interesting thing that we see on our side too. I'm also curious from your perspective, when we're talking about verticalizing for PayFacs, what happens when one goes bad and it affects the whole chain? Have you seen that? Because we hear the stories from the other side of, they want to get away from the PayFac for that reason. I'm just curious if you have experience with that, where there's one bad egg in the bunch and it spoils the whole basket kind of thing.
Wait, I think my question, are you talking, I want to make sure we're talking about the same people or, use cases here, more importantly. So are you thinking a, SaaS company who has now brought payments through a managed payment facilitator, or a provider out there that is offering
a SaaS company who has TIDs under them, basically, that are all customers of theirs? and they have one customer that's boarded that says, hey, I'm a gym just like everybody else, but really they're accepting payments for, I don't know, CBD or something that they shouldn't be accepting payments for.
The good old kratom.
Yes.
Well, I mean, listen, fraud is fraud, right? And this is the whole point on, do you actually become a payment facilitator? And most of the time I'm going to tell you no, right? The hopes is that if you're working with a managed provider, they not only have a risk team that is evaluating and looking for these trends and setting up product and people to do that, but that you also have functionality, right? To then set up another tier of risk rules, right? So we could catch all fraud, right? Fraud, I think in June of this year was already at 40 billion in 2023 in fraud in the industry. And that was doubled from the year before. So if we could prevent all fraud,
double again in 2024, by the way.
I would assume it will, right? I mean, I agree with you. So like, you can't prevent all fraud, right? I think the hopes here though is a compliance team within your provider should be able to help you define rules, right? Should understand your merchants and know what things to look like. And then because you serve a certain segmentation of customers, you should also know things that don't look right and have those tools and controls to set up another layer of prevention there, right?
And even to go in, I'll use an example, right? So Caleb over at Tilled, I know him really well. We've worked on a couple of different things, but he just recently posted on LinkedIn. Yes, I probably spend way too much time on LinkedIn, but he recently posted, he goes, am I that a-hole? Because he had a merchant reach out that said, hey, you held my money. You have no right to hold my money, blah, 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 blah. And come to find out, the merchant wasn't truthful. They didn't do what they said they were going to do. Now, there's some nuances in there that are in there, but when you start to look at a PayFac model, does that one spoil the entire basket, the egg, that one egg, you spoil the whole basket? No, because a lot of times when you have a crew like Caleb does on his risk team, they're watching for that stuff. So as soon as something happens, if they're paying attention, they're going to take action. The same action, Elaina, that you would take as being a traditional ISO. And so it really comes down to you can't be hands off. And if you are hands off or you're turning a blind eye to it, that's when everything goes upside down. Yeah. And I have seen it where they're like, oh, one person in here isn't going to be that big of a deal because this is there. Well, that one person is never one person.
Right. Yeah. Yeah. When they're using it to hide things, then that's not a good model.
Right. And there are a number, actually. There's 3 that came to me asking for help because they were put on match. And they were put on match because they were doing things that were too gray area without asking for clarity or working through it. Now, what they were doing, was it outside the brand regulations? No, it wasn't, but it was close enough that the processing entity felt that it was, so they made the judgment call.
And that's what happens.
Exactly what happens. I think there's two different things I think about as we talk about this. One, in Caleb's situation, there's always going to be a merchant that's upset. There's always going to be somebody in any industry, in anything that you do, right? You're going to have people who get frustrated, and you can do your best and say, hey, Caleb was obviously operating within the bounds of a contract, within the bounds of, Visa, MasterCard rules and FinCEN rules. Yep. And he's saying, I'm doing everything I need to do to protect the business, and not just my business, but my clients using it.
Yep.
I think where we don't see enough in our industry is communication to that merchant. Here's how long the funds are going to be held for. Here's the process. I don't know if that's the case with Caleb, right? I didn't read through the whole post, but I think that's where...
I didn't go into details on that piece of it.
But it's where things break down. It's like, were you using your contract? Were you in bounds of your contract? How would you explain that to the customer, though? Was it in terms that they could actually consume? And then I think we see this whole other side of this fraud conversation we're having, where I think there's some folks who have gotten too big too quick. who have taken a very horizontal approach, maybe didn't build the fraud tools or automate the things that they needed to do, took too much of a people approach, and have seen some pretty significant losses. And my question is, are they ruining it for new members or new entry points from the bank perspective, right? Are the banks going to continue to, and are Visa and MasterCard and these networks going to continue to allow folks to go direct if there is folks out there who aren't building the right tools? You can put your procedures down on any piece of paper you want, but if you don't have the automation and you're not using the right set of tools and mix between product and people, you're going to see big losses, and that's going to screw it up for everybody else.
You know, with you bringing that up, two stories from the past that come to mind. One is, do you remember back, God, it's been probably 10 years. In the annual report for Square, they had an enormous loss that was front and center on their annual report. And it was because they had approved a woman to be and it should a person, it doesn't matter if it was a woman, but approved a person to sell services for wedding planning. So wedding planning services, she was able to do that. Well, she wasn't getting as much revenue as she wanted. She looked for all these different ways. So she started selling travel vouchers as part of her wedding planning. Come to find out that the wedding vouchers she was selling weren't actually real. So boom. But Square knew nothing of her selling wedding voucher or travel vouchers. And so they took the entire loss out of all of that. So that is a place where, you know, when you have the risk, you're going to get hit, especially if you're not checking in and looking at things and taking that proactive approach. And there are plenty of softwares. I mean, that's one of the things I spend a lot of time doing is I look at situations, problems that people have, and instead of having to build it, because you don't always have to build it. Actually, most of the time you shouldn't build it because it's not your core competency. Looking at the products in the marketplace that you can bring in, you can plug in, give you enough visibility or enough information to be able to move forward. And then the other one that comes to mind is you were talking about now on the other side of the house, you got to have systems that when the alerts get thrown up, that you're not looking at hundreds of thousands of alerts because it is little bits and pieces. Because Coinbase, why did they lose a bunch of money in their annual report 2 years ago? It's because they had 100,000, I believe it was 100,000 alerts a day. And all their risk people were doing were going in and just, all they had time to do was just clear them out. They didn't even have time to actually look at them. Now, they fixed it since then, but that's a big issue. Now, what's really cool is that I've started to work with a handful of companies that are leveraging generative AI and a handful of other things to really look at this stuff, to bring the items that are most important or the most egregious or the most likely to become a loss to the forefront. But those are the two pieces that, as you're talking about it, like these are things that happen that a lot of people, especially if they're not from payments, don't really think about.
And there's only one way to learn that lesson with risk, and that is to get burned.
Well,
you have to take the big loss.
Right, to figure it out. We've all had them, right? Oh, yes. I definitely had them as a owner in the payment space myself. Like they happen, right? And it's never the way you think it's going to. But what I think about is as we have this PayFac conversation, if that woman was processing, right, with a SaaS provider, I think there's like Perfect Venue and Triple C, right, in that space, who specifically serve that industry. If they had the right fraud tools and the right partner, right, processing partner, we'll use processing partner broadly, take ISO, PayFac, whatever it may be, right? If they have the right
I can accept partner that.
And they have the right tools, would they have maybe looked at those alerts differently than somebody sitting in a horizontal team looking at fraud?
I think so.
I fully agree with that. Yeah, I think totally. That's the big piece that some of the technologies that I'm working with really help in the review to allow companies that have been very vertically focused to start to go horizontal, because you can have one that looks very, very similar, but there are a couple outliers, but you're not quite sure what they are until they happen. So, but we're using that generative AI technology, they're able to see those patterns. They're able to see the behaviors. They're able to look into these. One early adopter that is still one of my favorites. And it's going to be hard for me, but David and the team over at Featurespace, like they were one of the first people to really look at the behavioral side of the house, and they've been doing it for over 10 years. But now the level of data that we have access to and the processing power and all of these different things now are lending itself to other ways of using it versus just transaction monitoring. Right. So I could geek out about this all day long. I mean, generative AI and machine learning, that's a place that I'm a data geek that happens to like pretty stuff, aka UI. So
I'm with you though, Ted, as far as the AI, everybody loves to throw out that buzzword or term. And I think AI, when you pair it with risk, is the most exciting to me. There's so much opportunity there to help us understand the trends and have it do the work that we're doing. I just think there's a ton of opportunity there. So I get as excited as you do about that particular use case with AI.
I think the other use case I get excited about is support, right? I think there is going to be a lot of progress in support, and I probably beat on a customer experience too much, but I hate when you see a phenomenal SaaS company or ISV come to market and their payments partner screws it up for them. Like,
that's the hardest thing to watch happen.
Heartbreaking, right? It's like this everything we're trying to do is kind of set back in those moments. And I think we're going to see a lot of progress in how support can be integrated into, AI and machine learning and responding to things quicker and helping customers in the moment when sometimes it's hard to put a person in that situation all the time, 24/7.
Well, and I think last night I was with Integro Bank here in Phoenix, and we had a long discussion about AI. So it was a group of people. We got together really talking about how is AI affecting not only small businesses, but financial technologies in general. And looking at it, the piece that seemed to be a theme was it the AI that's being used today. Let's just use ChatGPT. The downside to that is it's able to give you an answer, but is it the right answer? Is it the right answer at the right time? Is it formatted right? And I think where the customer service or the customer experience is really going to come in. I don't think it's ready yet, but I think it's on its way. But being able to create the message in the way that that particular customer is expecting it to be. And not only that is the timing that goes along with it. Because if I'm a business that works from 9 to 5, Monday through Friday on the East Coast, if there's an outage on Saturday at 9 p.m., do I really need to be notified about it? And right now, it's this blanket piece that says, any merchants, tell them all. Hey, there might be a transaction that was affected by an outage.
And that's a bad look.
You
don't want to deliver that message.
Really dive into. Nobody wants to deliver the message, but you could.
But you do, I guess. We were talking about communication earlier, and I would always rather be on the right side of over communicating. But like you said, if it doesn't affect them, then it's just a bad look, because how many of those are you sending out? I don't want to have to send out these things that I have problems over and over again. And maybe it doesn't affect you every single time, but it's just not a good.
But the perception of your quality, the perception of everything just dramatically drops.
Absolutely.
And now with the expectation of real time everything, it doesn't even have to, just everything has to be real time. That isn't always good. And I think when you start to look at the payment facilitation perspective, that was one of the first things that everybody was trying to get to. How do I control the message? How do I do it in real time? How do I make sure that they know what's going on? I I agree with you, Ashley, is that I'm telling more people more often now to not any sort of PayFac. Just take your time, find the right partner, don't rush into it, make sure that everything's in place, because it's really hard to unwind something once you've got it in place. Maybe that isn't how you're looking at it, but that's how I interpreted
Seems like
your...
she disagrees.
We'll agree on part of that. Disagree on. So sometimes I think it's better to start, right? If that's the end game for the product, sometimes I think it's better to start early. I guess for a lack of better way to say it, there's some forgiveness when you're an early product, right? And people know if you're communicating where you are in your growth stage, people know they're working with an earlier stage product. And I would rather solve the problem for 2 merchants than solve the problem for 1,000 merchants. And so I do think there's something to starting early or scaling into it. Whatever model you pick that works for you, it's how you implement it and how you roll it out that matters. So anything's solvable if you don't just switch it over one day, fundamentally change the entire model of your business.
Cross your fingers, hope that it works.
Hey, let's do that. We're a payments company now, right? We were a SaaS company yesterday. We're a payments company today. That has to happen over time.
Yeah. Well, ladies, we've covered a lot of stuff today. Is there anything that comes to mind that maybe we haven't hit on, or just something that's burning in the back of your mind that you wanted to share on today's episode?
I have a question for the two of you, actually. I'm curious. We seem to be seeing everything as a service. And it's the same way with PayFac as a service. It seems like everyone is calling themselves that now. Are they justified in calling themselves that? Is it just the new buzz term that they're calling it that? Are there people in the space that shouldn't be in that space? I'm just curious your thoughts on that side of it.
I think it's some great marketing. It's a really good way to say we bill you for everything at small increments. And I'm being a bit facetious in that, but I think we saw software as a service, meaning things were delivered as they were used at increments that were billed as they were used. So the old adage of pay by the drink, that's really where the software as a service and or as a service model really was put at. But it's a nice and easy way for these companies to say, you're just renting it.
Yeah.
You don't have ownership of it.
Yep. I think it's consumable, right? When we're speaking to folks across many different industries that aren't payments experts, it's a way to alleviate all of the complexity. It's payments as a service, or it's issuing as a service. And so I agree. It's great marketing. Do I think there's some folks out there that are using that term that shouldn't? Yes, but that's through my lens again as a payments nerd and not through the lens of the actual person using it. Don't think they care. As long as they know what that term means is embedded, that's all they care about.
Well, fantastic. Well, I'm so happy that we finally got everybody on. I don't think we answered the question of should we, shouldn't we, who should, who shouldn't. But I think the main reason behind why we weren't able to really pull that out isn't because there's not an answer. It means it's because the answer is different for every individual company, every individual use case. If you're thinking about it, you need to take the time to really assess why you're doing it and whether or not you're solving the issue that you're trying to solve by becoming that. And is it really worth holding all of the risk and being the only one that's responsible for protecting that bag? So thank you so much for hopping on. And I look forward to many more conversations over time to really dive into some more of these things. But thanks again for hopping on.
Thank you, Tedd. It's been a lot of fun.
It's been a lot of fun. Thank you, guys.
Chargebacks drain revenue and may threaten your ability to process payments, but they don't need to be a cost of doing business. You can resolve up to 40% of chargebacks before they're ever filed. Here's how it works. When one of your customers contacts a participating bank to dispute a charge, you will be notified. At that point, you can avoid the resulting chargeback. It's fast, easy, and effective. You can be set up and preventing up to 40% of chargebacks in just 48 hours.
This has been a production of DV3 Media, with all rights reserved. This is provided for informational purposes only. It is not offered or intended to be used as legal, tax, investment, financial, or other advice. We strive to provide accurate and up-to-date information, but will not be responsible for any missing facts or inaccurate information. You comply and understand that you should use any of this information at your own risk. Cryptocurrencies are highly volatile financial assets, so research and make your own financial decisions.